Okay, folks, it's time, so I'm going to get started. By now, I'm sure you've checked your quiz, checked the solutions, you checked what you screwed up on. But here's my advice: let it go. I mean, it's 10%. It's your first quiz. You get a freebie. So if you did badly, that's your freebie. If you did well, that's good. But a lot of the class is still in front of you. Are there any questions before we start? So everybody's in a group. Everybody's got a company. Everybody's working on their company. I'm going to operate under this delusion for the rest of this class that you are actually working with me as we go through this class. It might be completely wrong, but that's what I need to do to kind of keep this class going. But I want to wrap up this beta discussion. So let's see where we started. We started by looking at betas as coming from regressions. You remember that's the way we're all taught. Run a regression, and we said the slope of the line is the beta. Then we kind of buried that regression beta. If you think about all of its limitations, it's backward looking, it's noisy, you can't get it for private companies and divisions. But at that point, I hadn't given you a replacement. And the replacement I hope I have offered you is, instead of trusting a regression beta, you do a bottom-up beta, looking at the business of businesses you're in. The advantage is you can reflect your company not only as it exists today, but as you expect it to be in the future. So if you're valuing GameStop, and you think it's going to evolve from a retail company to a gaming platform, guess what? You can use a beta that reflects that change. You regain control over the process. And you can get it for a private company, a division, a piece of a company. So that's where I left you, is with that discussion of betas for private companies. And I left you with a disquieting conclusion, right? Which is, if you look at a private company and an otherwise similar public company, if the private company is owned by a person who has his entire or her entire wealth in that company, they're going to be at a disadvantage relative to the person running the public company, not because they don't work harder, but because they're climbing this mountain of risk that they could have avoided. And you carry that to the next step. If private and public companies compete, public companies start with an advantage. That advantage is going to allow them to dominate the space and eventually drive out private businesses. And you see this happening in business after business. Public it drives out private. And even when you get transactions where public companies go private, as we talked about with private equity or KKR, Blackstone, the end game is to take them back public. Levi Strauss used to be a public company. Then it was taken private, but 2 years ago, it was taken back public again. The end game is still being public. So I want to make sure everybody gets that intuition of why costs of equities are higher for private companies with undiversified owners, because the last loose end I want to tie up is your company. So once you get to this point in your project, you want to get a bottom-up beta for your company. To get a bottom-up beta for your company, you have to tell me what business or businesses your company is in. For some of you, it's going to be easy. It's in a single business, you're done. For some of you, you might have to slice and dice. Just be careful that you don't slice and dice too much. In other words, if you create businesses where it's going to be, which are so narrowly defined that you cannot find publicly traded companies in that space, you're really not going to go anywhere. So as you start breaking your company down into businesses, first ask yourself, is this really a business or is this a subset of a business? I'll give you an example. Many retail firms have a financing arm. You know what the financing arm does? It issues credit cards that get used only in that retail store. So you walk into a Macy's or a J.C. Penney's, every time you shop, the guy or the person behind the counter says, would you like to sign up for a credit card? It looks like it's a financing arm, right? But it's really not. It's a captive financing arm because the only financing it does is of items sold in that retail store. I wouldn't view that as a separate business. In contrast, GE has a financing arm, GE Capital. Some of its business is financing aircraft sales through, so basically it might be something that they're financing as part of their business, but they also do financing outside. That's a legitimate financing business. So when I value GE, I might have to bring them separately as a business. So some of this is judgment calls. You have to decide what business to put your company in, and there might be no right answer. There might be the answer that you think best fits, but make your best judgment. My suggestion is don't get stuck. Move on. Keep moving. Because if you get stuck there and say, I don't know what to do, I'm not going to go to the next step, you're never going to get through this. Make an assumption and move on. Now, to get the betas for businesses, if you want to, you can use the betas off my website. I'm absolutely okay with it. The only thing is the betas, the businesses are broken down into pretty broad categories. I break companies, the 46,000 publicly traded companies in the world, into 94 industries. So I have retailing, but you say, what if I want just luxury retailing? Well, guess what? I don't have a luxury retailing beta. You have to do it yourself. It sounds like an onerous task. But I've been bugging you about using S&P Capital IQ. I know very few of you have taken advantage of it. But if you get a chance, get on S&P Capital IQ, and you can essentially create your own bottom-up betas. It's not difficult to do, and it's actually a great exercise. Incidentally, you did get my email about your case being online, right? So part of the case actually is getting a beta for for a discount rate for their project. The project is a Google electric car, and it'll make you go through the exercise of coming up with bottom-up betas. So any questions before we put bottom-up betas to rest and move on? Go ahead, John.
Yeah, I guess just in terms of deliverables for the final project, it seems like a lot of what's going into our presentation is, things that we're thinking about, assumptions that we're making. So how do we share that with you so that you see our thought process, or is that not important?
Well, it is. I mean, it does matter. In fact, the numbers don't matter that much because you just plug things in, you come up with a number. If you go to the project link on the on the class website and you click on it, you'll see examples of past projects. So you're not going into this completely blind. You can see what people did in 2018. So I have like 10 sample projects. Take a look at them, and you'll notice that the formatting varies widely. I think a couple of them are PowerPoint. A couple of them are, just more traditional storytelling. Some are built around tables, the formatting I'm flexible on, but you get a sense at least of what I'm looking for on the project. If you look at those past projects.
Thank you.
There would be a page limit though. So, and as you look at the format of the project, it'll show you what the page limit is. So I don't want 300-page documents because I've got to read them all. And it's going to be almost 80 projects just in this class, and I'll get 100 valuations in my valuation class, and there's only so much I can read through before I lose patience. So don't test my patience by turning in 80-page papers, because I'll stop on page 25 and say, hey, you didn't do 2/3 of the project. So do try, if you go an extra couple of pages, maybe 3 or 4 pages, I'm okay with that. But kind of keep it, you're not writing purple prose. You're taking numbers and telling me the story about a company. Essentially, that's your job, is to take the numbers and weave a story and say, this is what I see in my company now. This is what it does well. This is what it does badly. Carlos?
Yeah, for the bottom-up approach using Cap IQ numbers, is it okay to use Cap IQ's debt equity ratios?
No. Never use a ratio from any service. I'm glad you asked. Never use a ratio from any service.
Okay.
But they do have total debt and they have market cap. And you can compute. You say, why would I do that if they've already done it? Because when you use a debt to equity ratio computed by a service, you have absolutely no idea often of what goes in there. Sometimes they use books, sometimes they include leases, sometimes they don't. So why not control the process yourself? You have the debt, you have the equity, it's just one ratio. So don't use any ratios. Just compute the ratios yourself, because the raw data is there. So when you do the capital IQ, just download the raw data. So the raw data will be, you need market cap, you need total debt, you need revenues if you want to compute that EV to sales ratio, right? And you probably need cash to get a sense of how much of the company is cash. So if you look at the data that I put for the studio companies, you'll pretty much get a sense of what you should be pulling up for your company as well.
Yeah. Thank you.
So now let's move to the other part of capital. So all this time we've spent on coming up with the cost of equity, right? Risk-free rate, beta, risk premium. But equity is only one of 2 ways of raising capital. So what I now want to talk about is debt. And I want to start with a simplistic question. It might sound almost like an absurd question. Before we attach a cost of debt, we need to define what debt is, right? You're saying, I know what debt is. It's whatever's on the balance sheet. If it were only that easy. To talk about debt, you first have to start by looking at the criteria that make debt into something separate from equity. And there are three things I would look for. The first is debt usually requires a contractual commitment, right? To make interest payments. That contractual commitment doesn't have to be the same payment every year. A floating rate bond, you make a contractual commitment that the interest you pay will be whatever the T-bill rate is plus 2%. So it's a contractual commitment. Second, that contractual payment you make each year is usually tax deductible, usually. There are some parts of the world where this is not true, but in the bulk of the world, that contractual payment is tax deductible. And third, if you fail to make that payment, bad things happen to you. Like what? Your knees could get broken if you're a private individual. But if you're a company, you could default. You could be put out of business. Contractual payment, tax deductible, loss of control. You ready? I'm going to start listing items off a balance sheet. And then I'm going to call on some of you to tell me whether I should count that as debt based on these three criteria. Jeremy Moskowitz, let's start easy. Bank loan. Long-term bank loan. Obviously, right? Fixed payment, tax deductible, loss of control. Matthew Olstein, how about corporate bonds?
Debt.
Absolutely. Marissa, what about short-term bank debt?
Yeah, that's also debt.
You see why I brought up short-term? I am amazed at how many investment banks I talk to, where you look at the debt-to-equity ratio, they count only long-term debt. So what are you telling me? If I take a 6-month loan, I don't have to pay it back? All interest-bearing debt is debt. Short-term, long-term doesn't matter. So that's easy. Now let's get to the trickier items. Marta, how about accounts payable? You know, when you look at a company, it says accounts payable, supply credit. Should I count that as debt?
No, it's not that.
Okay, tell me what criteria it fails on then. What does it not have?
So it is a contract. It's not tax deductible. Or is
it
not, right?
It shows up in cost of goods sold eventually, right?
Uh-huh.
It's a contract, you've agreed to pay it. You know what's missing in accounts payable and supply credit? An explicit interest payment. Notice what I said, explicit. Is there a cost to using supplier credit? Because a supplier comes to you and says, you can pay me right away, or you can pay me in 50 days. He's not stupid, right? What does he offer you as a bonus if you pay right away? He wants to be paid right away. So what do you usually get when you get paid right away? Marta?
So when you get, can you repeat the question? Discount?
So supplier, let's say you're a restaurant, you buy the food, and the supplier says, look, it'll cost you, it's 50,000. You can pay me right now, or you can wait 30 days.
Yeah,
you obviously want to be paid right now. So what does he usually offer you when you pay right away?
A discount, an incentive.
Discount. That is really an implicit interest expense. When you use supplier credit, you lose that discount. So you know where I'm going? If you're willing to make that implicit discount into an explicit interest payment, I'm willing to count supplier credit and accounts payable as debt. But until we do that, I'm going to keep that outside. I'm going to make it part of working capital. It will not show up as debt. For some of your companies, don't be surprised to see billions of dollars in accounts payable and supplier credit, but you're not counting it as debt. But be careful about why. It's not because it's not contractual. It's not because it's not tax deductible. It's not because you won't get into trouble if you don't pay the suppliers. It's because the interest payments are not made explicit. It's hidden into your cost of goods sold. So supplier credit is not there. Accounts payable is still on the balance sheet, right? Let's say you're a retailer, and this is 2018. There's a reason I'm putting a year in front of this. 2018, you open a new store. Almost every retailer in the US, when they open a new store, they lease the store. They don't buy the real estate and build the store. A few of them do, but most of them lease the store. So it's a mall, and you sign a 15-year lease. So you can sign the contract, contractual commitment to make those payments? Absolutely, right? Tax deductible? Yes, lease payments are tax deductible. And if you fail to make your lease payment, what happens to you, at least on that store? Initially, you give up on that store, but if you fail on a bunch of leases at the same time, you go bankrupt. Caldor and Bradley's, 2 discount retailers in the US, went bankrupt because they could not make their lease payments, not because they couldn't make traditional debt payments. Contractual commitment, tax deductible, loss of control. Leases have always been debt. But until 2019, you know what accountants did? They did the stupid dance of, if the lease doesn't give you, they drew a line on ownership. If you didn't technically own the property, if it was a lease, it's called an operating lease, it wasn't treated as debt, it was put in the income statement as an operating expense, and nothing showed up on the balance sheet. It was absolutely stupid. But for much of accounting's life, they did this stupidity dance of saying it's not debt. We talk about off-balance sheet debt, and we think about all this fancy stuff. In 2018, 80% of the off-balance sheet debt of all companies in the world took a form of lease commitments. Leases are definitely debt. And finally, in 2019, both GAAP and IFRS came to that unsurprising conclusion. So today, if you look at Walmart or Target, in addition to seeing bank debt and corporate bonds, you're going to see lease debt. You're saying, how do they come up with lease debt? I'm going to take you through the process of how I've always capitalized leases, because I've been doing this since the 1990s. It's a very simple process, and I'm afraid accountants are going to screw it up by doing fancy stuff. But the process itself is pretty straightforward. So all interest-bearing debt, all contractual commitments. And I'm going to open the door to contractual commitments and bring in a few more examples. But I want to make sure everybody is with me so far. Carlos, you have another question, or is your hand up from before?
I do actually have another
Go ahead.
question. But so looking at your top 10, just going back to the kind of betas debt equity thing, and sorry to go back to this. You talk about using median debt equity ratios. Is the goal to compute debt equity for all companies in a given sector or space?
Why do we use a median as opposed to an average?
To get, yeah, I figured that, but I guess in terms of like the Excel sheet you sent us, we just calculate the debt equity ratio for our company. Is that all right to
But you
use
have
that
to
number?
unlever the industry average, right? To unlever the industry average, you need the median debt to equity of the industry average.
Yeah, okay.
So you need that to get the unlevered beta.
Thank you. Sorry about that. Thanks.
So let's go back to debt. Let's talk about the cost of debt. I'm going to lay out what I'm trying to estimate, then we'll talk about how best to estimate it. The cost of debt is the rate at which your company can borrow money long-term today. Let me repeat that again. The cost of debt is the rate at which your company can borrow money long-term today. There are 2 pieces to that definition. One is, it's what you can borrow money at today, not what you borrowed money at 2 years ago, 5 years. So don't show me your existing debt and what you bought. I don't care. Second is, it's long-term. Even if you're borrowing short-term debt, I'm going to attach a long-term cost to it, because my argument is, if you take short-term debt and it's lower rate, it's got to be rolled over to fund the project, and it's going to eventually come up with a long-term rate. Long-term cost of borrowing money today. That's my end game. So let's suppose you're looking at a company and say, how the heck am I going to estimate it? Let's start with the easiest scenario. Let's say your company borrowed money from the bank yesterday, and the bank set an interest rate of 4.5%. Don't look a gift horse in the mouth. This is your cost of debt. This is as close to right now as you're going to get. It's a long-term borrowing, and you can use that. You're almost never going to get that lucky. So I'm going to go through the process of estimating cost of debt. And I'm going to talk about the tool we're going to use to estimate it. I'm going to outsource it. I'm going to first look to outsource it. What do I mean? There are services out there that try to measure how, because if you think about how much your company has to pay, it's got to pay a credit spread over and above the risk-free rate. Risk-free rate will be a long-term risk-free rate. Why? Because I'm looking at a long-term cost of borrowing. So the same risk-free rate used to build your cost of equity will become the starting point here. But on top of that, I'm going to add a default spread for your company. If you're a company with a lot of credit risk, that spread is going to be larger. If you're safer, it's going to be smaller, but it'll never be less than zero. Why? Because no company, no matter how, how safe it is, can ever be default free. You can't print your own money. So the question is, how do we estimate the default spread? Now, as you do all of this, remember, you've already made your currency choice. When you did cost of equity, you've decided to do everything in dollar terms. Don't change your mind here and say, I'm going to do my cost of debt in real terms or in peso terms. That'll be a mismatch. So if you've decided to do dollar terms, your risk-free rate will be in those same terms. So I'm going to take you through the process of estimating cost of debt for companies where it gets easy. And this is when somebody else tells you how much credit risk there is in the company. I'm not going to be mysterious, but many companies have bond ratings. Basically, S&P, Moody's, Fitch put a rating on the company. For Moody's and S&P, the ratings go from AAA, which is their safest companies, all the way down to D, which is in default. So it goes AAA, AA, and there are pluses and minuses along the way. But basically, if you give me a rating for a company, and I believe the ratings engine, that's a big if I believe the ratings engine, that then becomes your measure of default risk. 3 of my companies had ratings: Disney, Deutsche Bank, and Vale. They were S&P ratings. They were rated, Disney and Deutsche Bank were rated single A, Vale was rated A-. You know what? They made my life a lot simpler. Because if you tell me the rating for your company, I can tell you what the typical default spread is right now, because there are other bonds out there with that rating that are traded. I can look at the spread of those bonds. In 2013, for instance, single A rated bonds had a default spread of 1%. So that's what they were earning over and above the risk-free rate. I'm done. My pre-tax cost of debt for Disney is going to be my risk-free rate. Remember, that's 2.75% in November of 2013, plus 1%, the default spread. Gives me a pre-tax cost of debt of 3.75%. With Deutsche, with the single A rating, I take the 1% default spread and I add it to the risk-free rate in euros. So the fact that there's a currency difference shows up in the risk-free rate, and my cost of debt pre-tax for Deutsche Bank is 2.75%, the risk-free rate in euros plus 1%. For Vale, I take the A- rating, the default spread in 2013 was 1.3% for an A- rated bond. I add that to my, remember with Vale, I decided to do everything in US dollars because they're a commodity company, and my pre-tax cost of debt is 4.05%. You're saying, what if I'm doing Vale in reais? Not a problem, right? Because remember how we adjusted the cost of equity for inflation? If I know my cost of debt is 4.05% in dollars, and the inflation rate is 9% in reais, and 2% in dollars, my cost of debt in real terms, I can adjust my 4.05% for the additional inflation, and my cost of debt is 11.19% if I do everything in reais. So if I have a rating, my life just got simpler. So if you're in front of your computer, here's how you can check to see whether your life just got simpler. Type in Moody's, the name of your company, and if nothing shows up, your life just got more difficult. But if you're rated, you'll find it. So it's easy to find the rating for your company, even with a Google search. So either Moody's or S&P, if your company's rated, you can take the rating. The weakness of this approach, of course, is the ratings agencies are screwing up. That screw up is going to show up in your cost of debt, and at least you can blame somebody else if something goes wrong. Any questions about a rating? I'll give you the bad news though. Only about 10 to 15% of companies globally have a rating. The rest, you're on your own. And even when you get a rating for a company, be careful. You'll find ratings for individual bonds and ratings for a company. You want the rating for the company, not the rating for an individual bond, because you can be a risky company issuing a safe bond. The rating for the company assesses the default risk for the entire company. So often you'll see S&P say the rating for Home Depot is A, but on this particular Home Depot bond, the rating is A+. Go with the rating for the company because that's what gives you the cost of debt for the overall company.
What if S&P, Moody's, and Fitch give like significantly different ratings for a company? I guess that's rare, but does it ever happen?
That's rare. If they do give you different ones, it's rare because one of them then is lagging. Let's face it, ratings agencies are not magicians. How do they come up with the rating? They look at your financials. They look at what happened last year. A committee meets in each, and they're very careful about changing ratings because this is consequential for them. So sometimes you can have a lag, especially if something bad's happened to a company where one ratings agency will do it faster than the others. That's when you get a mismatch. Go with the most recent upgraded rating because that's probably more reflective, because you almost never will get a company where there are huge differences between the ratings agencies. Brian?
Are the default spreads currency independent?
No, they're dollar spreads, but you can get away using them as long as the risk-free rate you're working with is pretty close to the US dollar risk-free rate.
Okay, that's why the euro works.
That's why the euro works, and that's why for the REI, I actually did the dollar and did the inflation approach will work if you have a very different. So basically, you can do things in dollars and convert it to different currency if the risk-free rate is much higher. David?
Yeah, why would a bond have a different rating in the company?
Because, let me reframe the question and put it back to you. Can a risky company issue a safe bond?
Yeah, have specific protections in there.
Exactly. I can secure the bond with my safest assets. And that's why I never use the yield to maturity, because people often ask, why don't you just go to Bloomberg, find a bond issued by the company, take the yield to maturity and use that as your cost of debt? Because I have no idea what that bond is capturing, right? The safest part of the company, the riskiest. So that's part of the reason why you might have a rating for a bond that's different from the rating of the company. Shreya?
If my company has a parent entity with a higher or a better credit rating that's giving it a corporate guarantee, so if Tata Sons were to give a corporate guarantee to Tata Motors debt, would that affect my rating? How do I factor
It already sometimes shows up in the rating. So you look at Chrysler, for instance, the way they rate the Tata companies is they know, did everybody get the question, which is if you're part of a family group, and so think like a lender, right? You're lending to a company in a family group. Even if that company is risky, what makes you feel more comfortable when you're lending? If that company gets into trouble, the family group will find a way to pay you. It's a very dangerous presumption because contractually you're not entitled to it. But let's face it, for as long as we've had people lending, they've lent not just to the company, but for the backers of the company. But once in a while they get burnt. There's a sad but true story of what happened with the port of Dubai borrowed money. For those of you familiar with the United Arab Emirates, Abu Dhabi is really the bank behind it. It is the richest of the Emirate countries, and so when people were lending to the port of Dubai, even though it was a risky entity, they said, but Abu Dhabi would never let Dubai ports default. So we're going to set the rates lower and assume that Abu Dhabi will step in. So the time for the debt to be paid comes about, and Dubai ports is unable to pay it. So the bankers go to Abu Dhabi and say, hey, they couldn't pay the debt. Can you make up the difference? And Abu Dhabi said, can you show us contractually where we have to do it? The danger of setting a cost of debt for a company based on a parent group is it can put both the lender and the company in trouble. Because in a sense, you can see why the company's then in trouble. It's taking projects that make too low a return because it expects to get subsidized. So my suggestion in those companies is actually, I'm going to give you a way of estimating a rating for a company, is to replace the rating for the company with what you think the company would have had as a standalone company and use that in your cost of capital.
Even if it is contractual?
Even if it's contractual, because what is the cost of capital used for? To decide what projects to take. And my worry is you're using subsidized debt to take projects you otherwise wouldn't have taken. You're hurting the family group. So in a sense, it's not good for anybody in this game to have subsidies floating around. And since the cost of capital is really about figuring out what the value, how to pick projects, which projects to take, I would try to get a cost of capital that actually reflects what it costs me to raise money. Sushant?
Yeah, so I'm kind of unable to understand how a bond for a company might be higher rated than the company itself. As in, it says that the company might be default, but the bond won't default.
No, that's not
Something
what it
which I-
says. A bond basically is just a contractual guarantee backed up. So if you're a company and you take your safest assets and you carve a bond issue against the safest assets, you'll get a lower cost of debt on that bond. But what I'm computing as a cost, but when you do that, think of what happens to the rest of your debt. It all gets risky, right? Because in a sense, the rest of the people now have the riskiest parts of the company. What you're trying to compute as a cost of debt is an average across. That's why you don't want to use just senior debt, right? If you have senior debt, you try to get debt that reflects the total company. And that's what the cost of debt is trying to do. So you're saying, what do I do if my company doesn't have a rating? As I said, that's not uncommon. So don't freak out. Don't email me saying, should I change my company? I can't find a bond rating. It's okay. As I said, 85 to 90% of companies don't have a rating. Here's what I want you to do. I want you to be your own ratings agency. Don't get intimidated. As I said, there's not much there. In fact, ratings agencies for the longest time gave away the game. If you go to the S&P website, they would list the 8 financial ratios they use to rate companies. EBITDA to fixed charges, EBIT to interest expenses, debt ratios. So they said, these are the 8 ratios we look at to make judgments. So about 30 years ago, I said, look, I'm going to create my own ratings agency. I'm going to do what they do. And here's how I proceeded to build the agency. I said, look, I know these 2,000 companies have ratings. I know that the ratings agency tells me these are the 8 ratios they use to come up with the ratings. I'm going to do some reverse engineering. You know what I mean by reverse engineering? I took the 2,000 companies, sorted them based on ratings from AAA to D, and then I looked at the ratios to see if I could find a pattern. In other words, can I figure out how the ratings agency came up with these ratings? And I discovered 2 things. Out of the 8 ratios, 1 accounted for 50% of the variations in the ratings, and the other 7 put together explained another 10%. You're saying 50 plus 10 is only 60. 40% of the ratings couldn't explain using just the ratios because there's qualitative factors. They cut all over, right? Big company, long history, large company. But 60% of the difference in ratings can be explained by 8 ratios, but 50% of that 60% came from 1 ratio. That ratio was the interest coverage ratio. What's the interest coverage ratio? It's operating income divided by interest expenses. So if you look at my 5 companies, I've taken the operating income in 2013 and divided by interest expenses. So Disney has an interest coverage ratio of 22.57, but Tata Motors has an interest coverage ratio of 4.5. Now, before we use these ratios, think like a lender. When you look at a company that you're thinking of lending to, do you want this ratio to be a high number or a low number? Kushal? If as a lender, would you want this interest coverage ratio to be a high or a low number?
A high number.
High number, because there's a lot of buffer then, right? Because then you can have a bad year and still make the interest payments. So higher interest coverage ratio should go with higher rating. Everybody with me so far? But that doesn't help enough. I need to tell you what the rating will be for an interest coverage ratio. So remember those 2,000 companies I originally looked at with the ratings? I used those 2,000 companies to come up with the lookup table. I update that table every 2 or 3 years. But the lookup table, here's what I do. I tell people, you tell me your interest coverage ratio, I'll guess your rating based on companies that are already rated. And I discovered very quickly that ratings agencies seem to have 2 sets of rules, one for small companies and one for big companies. And their distinction was based more on market cap. So if you were a $50 billion company, they cut you a lot more slack than if you're a $3 billion company or a $100 million company. You're saying that's not fair? And life's not fair. That's how they rate companies. So I created a lookup table. And in this lookup table, first question I ask you is, what's your market cap? Why? Because I want to decide which table to use. So let's play along. Let's say you're Disney. Your market cap is huge, 130 billion. You're a large market cap company. Then I ask you, what's your interest coverage ratio? 22.51. And if you go to the table, 22.51 puts you well above 8.5. So if I were rating you based just on the interest coverage ratio, I'd give you a AAA rating. Everybody so far, and what I've done, I've taken your market cap, I've taken your interest coverage ratio, gone to the table, looked for the ratio, and given you the rating, AAA. Let's take Vale. Vale is a large cap company, but also is an emerging market company. And that's the other thing I forgot to mention. That's the other area which is a little unfair. An emerging market company, no matter what its market cap, seems to be treated more like a small cap company than a large cap company. Again, you can bitch and moan about this and say this isn't fair, but it is what it is. So if your interest coverage ratio is 11.67, and I treat you like a small company, 11.67, so if you look at the second column, falls in the second, and if you go across, that's a AA rating. So for Vale, the rating I gave them was AA. Tata Motors, 4.51. Emerging market company, you go down, they barely make the cut between BBB and A-, but I'm going to give them the A- rating because they're just in that range. So with every company, I take the interest coverage ratio, I look at the market cap, I look at whether they're developer emerging, I use the table to come up with the rating. I've automated this in that Excel spreadsheet that you would see on my website. Because I can ask you a question, what's your cap, what's your market cap? Are you developed or emerging market? What's your interest coverage ratio? And then I go to the lookup table, I look up the interest coverage ratio, I have your rating. It's called a synthetic, I call it a synthetic rating to be very clear that this isn't from Moody's, it isn't from S&P, it's from me. I made it up. But I made it up based on observing what they do. So it is a rating that you can then use the same way you would an S&P or Moody's rating. Any questions? In fact, I took Bookscape, which is a private company, which will never be rated. I took their interest coverage ratio because remember, you can compute an interest coverage ratio for any company. It's operating income divided by interest expense, public or private, you should be able to do it. And I said, if they were borrowing money based on a rating, what rating would I give them? I gave them an A- rating. I have a way now of estimating the cost of debt for the rest of my universe, companies that don't have ratings. Joe?
Yeah, I'm wondering how we are calculating the interest coverage ratio. Is this a projection or a historical average, or like maybe the most recent,
That's a
quarterly
very
data?
good question. Joel, let's think like a lender. If you're lending to a company, do you lend based on last year's interest coverage ratio or the expected interest coverage ratio in the future?
The projection, yeah,
The
expected.
projection. But then we have an estimation question. How do we project it? And we will start with the past. And what's your first reaction when you look at 2020? Maybe I should take it out. It's a terrible year, but there's a reason for it being a terrible year. And if you don't like 2020, and if you're looking at Marriott, you say, man, let me look at 2019, 2018. The estimation process is wide open. I'm not saying use the interest coverage ratio from 2020 for your rating because it might not be fair to the company, especially if it was affected in 2020. But there's nothing in this process that says you cannot use an average interest coverage ratio over time, or if you have good projections, why you can't use projected interest coverage ratios. That table works whether you're projected, average, last year's number, and which one you use will really depend on the company you're looking at. That's the subjective judgment you'll have to make for your specific company. So Shant?
So the emerging market companies were considered a small cap because of the currency as in dollar denominated bonds?
No, it's not even
some other
currency. It's
reason?
just that emerging markets are viewed as riskier. So I don't even think currency is the issue. That's why I said it can sometimes be unfair. Because if you're a Brazilian company that gets 100% of your revenues in the US, you're saying, why are you penalizing me? And the ratings agency's reaction might be, if I need to get my money back, I have to sue you in a Brazilian court, and who knows what the contractual, can you imagine suing in an Indian court for an interest payment that's due to you? What's the waiting time, like 55 years before they get back to you? You might as well just say, write the whole damn thing off. So I think that with debt, at least, you worry a lot more about where a company is incorporated and how easy it's going to be to get your money back. Now, with 3 of these companies, so remember I had an actual rating. So now I have a synthetic rating and an actual rating for the 3 companies. And I was curious about how close or far away I was. Jack, your question?
Yeah, so I think I missed something. So wait, Waller's a large cap, but you're using the small cap rating for it?
Because it's an emerging market company. So cap is the first cutoff. The second is developed emerging. So all emerging market companies go into the small cap, even if they're large. So if you're a developed market company, large cap, that's the only case where I would use the large cap column. So let's take the three companies where I both a synthetic and actual rating. Let's see if I got close. With Disney, do you remember what the actual rating was? It was single A, right? What's the rating I'm giving them? Triple A. Clearly, I'm overrating the company. Well, one reason for that is I'm using 2013 income. And 2013 income was a historic high for Disney. They had a really good year. So one explanation is you're probably overrating the company because you're using a really good year. For many of you, you're going to get the exact opposite in 2021, which is use a synthetic rating for your company and use 2020 operating income. For most of your companies, you probably come up with a rating lower than the actual rating. But there's a reason for that. You use 1 year's number. If you're a lender, you're thinking about what will they do in the long term. The fix for that is very simple. Look across time, look at now. In fact, if I'd use Disney's average interest coverage ratio over the last 5 years, I get closer, I get an A+ rating. Still off by a notch, but that's close enough. For Vale, I get a AA rating, but their actual rating is A-, and here there's a really good reason for it. Remember I said that there's this penalty that gets built into emerging market companies? For a long time, ratings agencies actually made that penalty explicit. And here's how they made it explicit. No company in a country was allowed to have a rating higher than the country. Let me repeat that again. No company in a country was allowed to have a rating higher than the country. It was a rating, it was called a sovereign rating ceiling. Can you imagine being the safest Venezuelan company? You're already dead in the water, right? Because your rating is going to be capped at what, double C, single C? I thought it was incredibly unfair, but it was a bludgeon. And about 15 years ago, they relaxed that bludgeon. They're no longer an explicit rating ceiling, but it's still embedded in the process, which means if you're an emerging market company and S&P and Moody's are rating you, they're going to factor in where you operate in your rating. You already noticed the barriers that if you're an emerging market company, how much more difficult it is to climb into the top ranks, because at every level, there's this additional layer that I throw in front of you, say, get over that barrier. It's much easier building a great company when you don't have country risk kind of dragging you down at every step, but it's there. With Deutsche Bank, I have a single A rating, but notice I did not compute a synthetic rating. And I kind of gave away why, right? Remember last session when I did banks and I computed a bottom-up beta? What's the step I skipped? I didn't unlever and relever. Nathan, do you remember why I didn't unlever and relever the debt for a bank? What was my reasoning for not unlevering and relevering?
I think it had something to do with like how to decide what was debt and what was not.
Yeah, so banks, I said, I don't even know what debt is. And if I can't define what debt is, how the heck am I going to define interest expense, right? And if I can't define interest expense, what the heck is an interest coverage ratio? I'm going to be walking in circles here. If you have a bank that's unrated, come talk to me. Hopefully none of you pick banks. And one of the reasons I've talked you away from the ledge when you said, can I pick a bank? Is precisely because of these little indignities that get leaped along the way. Say, what do I do now? So with Deutsche, I'm just going to take the actual rating and say, please God, let them not be wrong on this one. So now I'm ready to compute my cost of debt. For the three companies where I had an actual rating, I said the ratings agency is using a much richer set of data than I am. And they are, right? I'm using only one ratio, an interest coverage ratio. They're using the other 7. They're talking to the management. So I'm going to give them the benefit of the doubt and go with their rating for the three companies. So it's single A rated for Disney and Deutsche, A- for Vale. And I get a cost of debt, as I said, by adding the default spread to the risk-free rate. But if you notice, the way I've described the cost of debt up to now is a pre-tax cost of debt. You're saying, what do you mean pre-tax cost of debt? Because tax codes in much of the world are tilted towards debt. Interest expenses are tax deductible. What does that mean? If you have a 30% tax rate and you pay a 4% interest rate, think of what you get. You pay 4% as your interest rate, so that's $4 out of the door. But that year when you pay taxes, you claim the $4 as a tax deduction, which means you save $1.20 in taxes, the $4 times the tax rate. Net, you actually paid only 2.8%. your cost of debt, because of the tax code, after tax will be lower than your pre-tax cost of debt, assuming you're a tax-paying company. If you're a money-losing company, don't even talk to me about tax advantages. There are none. Which raises the question of what tax rate should I use? So let me throw two different tax rates that you will see through the course of this class or through pretty much everything in finance. And I'd like somebody to help me distinguish between the two. So Dana Hill, the two tax rates I'm going to throw at you are an effective tax rate and a marginal tax rate. So Dana, can you help me on what an effective tax rate is?
I'm thinking that it's like sort of what they say the tax rate is.
And how do they usually compute? When they say it's a tax rate, they back it up by showing you what calculation?
I'm not sure actually.
You go to the income statement, they'll show you taxable income and taxes. Actually, I mean, you can't really play games with this. You take the taxes divided by taxable income in the income statement. What you get is called an effective tax rate. I actually report effective tax rates by sector on my website. So you go, you can see my effective tax rates for advertising companies, technology companies. Last year, the average effective tax rate for US companies was about 16%. Yes, everybody with me so far. So effective tax rate, I don't know whether any of you do your own taxes. Do any of you use TurboTax? You know how after they torture you for 3 hours asking you questions, you say, what the heck are you asking me this for? When you're all done, they depress you completely with the final statement. Say, congratulations, you're all done with your taxes. This year, you paid 18.3%. No, none of you is ever going to pay that low an amount. 28.3% of your adjusted gross income in taxes. I don't know why you're congratulating me for paying this tax. But basically, the way they compute 28.3% is they take your taxes, divide by your taxable income, the adjusted gross income. That is what an effective tax is. It's a tax rate across all of your income. Priyanshu, what's a marginal tax rate?
I don't know. Pass.
Okay. Lee, you want to have Lee Axelrod? What's a marginal tax rate?
The marginal tax rate is the tax rate applied on like the last dollar that you pay in taxes. Is that correct?
Okay. What's a marginal tax rate in the US for corporations?
30%?
Well, it used to be the marginal tax rate used to be close to 40% because you start with 35% as a federal corporate tax rate, plus state and local taxes, 40%. In 2017, the US had the highest corporate marginal tax rate in the world. Then you had the 2017 Tax Reform Act. Does anybody know what it lowered the corporate tax rate to?
20?
21. Plus state and local taxes, you're about 25%. The marginal tax rate in the US is 25%. So you have two numbers here, right? The effective tax and the marginal tax rate. For every one of your companies, those numbers will be different. For most of your companies, the effective tax rate is going to be lower than the marginal tax rate for a bunch of reasons. One is they have income in foreign locales that get taxed at a lower rate. The second is they have tax deferral helping them out, some strategies. So now you're faced with the choice. I'm computing cost of debt. Should I use my effective tax rate? For Apple, for instance, last year it was 18%, or should I use my marginal tax rate, which is closer to 25%? So I'm going to throw that question back to you. Which tax rate do you think I should use to compute cost of debt, an effective or a marginal tax rate? William Clemens, you want to try? You got a 50-50 shot anyway, right? Effective or marginal?
We're going to say the effective tax rate.
Okay, so let's work this through. What's the benefit of interest? It's tax deductible. So let's play a game. Let's say you have $100 million in income and 10 million in interest expenses. Okay, so before the interest expense, you had 100 million, you have 10 million. So when you do your taxes this year, you take the 100 million, you subtract out the 10 million, and you report taxable income of 90 million on which you pay taxes. Think of where you saved on your tax. It wasn't the first 10 million. It wasn't on the middle 10 million, it was on your last 10 million. Interest saves you taxes at the margin. It's one of the reasons the US tax code is so incredibly perverse. Because when the tax rate in the US was 40%, the effective tax rate was about 18 to 20%, not much higher than it is today. But you know what the dysfunctional feature of this was? When you borrowed money, you got the 40% tax benefit, but you were actually paying only 18 to 20%. The marginal tax rate is the tax rate we use to compute our cost of debt. I don't know how many of you plan to stay on in New York after you graduate, or was still move to California to work. I love being in California, but the one thing I don't like is my marginal tax rate. As an individual, you want me to depress you? Let me start. What's your, so let's say you are successful. I'll make that reasonable assumption. You make a lot of money. 200,000 will put you into a lot of money. You know what your federal tax rate already became when you hit 200,000? What's your federal tax rate as an individual when you get to about 200,000? You hit the highest tax rate. You're at 36%, 37%, I think. So you think that's terrible. Hey, I'm not quite done with you. 37% was my first slice of you. You still have to pay taxes to New York State. You know what the marginal tax rate on a $200,000 income is in New York State? It's about 9%. Okay. So now 37 plus 9, you're pretty close to 45%. Don't relax yet. I'm not done with you. You live in New York City, right? Who wants to live in Hoboken when you're this successful? That's another 4% that I'm going to take off you. It's only a matter of time before Chelsea lines up and says, we want 2%, and then your neighborhood lines up and says, I'll take an extra 1%. Your marginal tax rate just got very quickly up to 50%. So that first paycheck, you see, what the heck happened? How do I become, Elon Musk? Why am I looking? You are paying 48 to 49%, maybe 50% of your marginal, your effective tax rate might be 36 or 37%, but your marginal tax rate is 50%. So when you buy that next apartment, you see why you're going to be inclined to borrow money and why you're more inclined to borrow money when you're making more income than when you're not. Because when you borrow money at 3%, whatever the mortgage rate is now, remember, mortgage payments are tax deductible. Unless you're in New York, because they've cut off that as well. But no, but to the extent that they're tax deductible, you're effectively borrowing money at 1.5%. It's the after-tax cost of debt here, and I'm computing that after-tax cost of debt as your pre-tax cost of debt net of your tax benefit. Now, there's one company I've kind of left out, Tata Motors. They had a rating, but the rating was not from S&P or Moody's then. It was from an Indian ratings agency. Now, I know people at Chrysler, they do a great job, but they rate companies relative to other Indian companies. So AAA rated Indian company is an Indian company rated against other Indian companies. I'm going somewhere with this. They've given a AA minus rating to Tata Motors. And earlier we talked to Shri, I talked about the family group backing. That's all reflected in that rating, a AA minus. Now that AA minus rating is not essentially equivalent to a AA minus from S&P. I can't just take the default spread because it measures the risk of Tata Motors within India. You know what it doesn't capture? That there's a country risk component. So to compute the cost of debt for Tata Motors, I'm going to start with the risk-free rate in rupees. That's 6.57%, but I'm going to add two default spreads. One is the default spread for the country. Something I didn't do for the US, right? Or something I didn't do for Vale because I was doing things not just in dollar terms, but with an S&P rating. I added the default spread for India, which is the 2.25% that I subtracted out. So it's almost like I'm reversing what I did when I got to the risk-free rate. I'm adding the 2.25%, and then I'm adding a default spread based on the rating of AA minus, giving me a pre-tax cost of debt for an emerging market company as the sum of those default spreads. So let's review where we are. If you picked an emerging market company, and you can find an S&P or Moody's rating, you just got lucky. You can do what I did with Vale. But if you can't find a rating or you have to do a synthetic rating, then you have to remember to bring in the country default spread into your cost of debt. And that then becomes your cost of debt that you use to compute your after-tax cost of borrowing. Any questions on that? So the key number here is, once you got the rating, is the default spread, right? You think those numbers change over time? Of course they do. January 2021, for instance, you can see it's that first column. I'm sorry, it's reversed from where it should be. So basically, I've given you spreads from 2015 to 2021. And you can see they go up, they go down. 2021, they're back to being pretty low. Default spreads change over time. But 2020 was a wild ride. And are you surprised? Remember what I showed you with the equity risk premium in 2020? Between March and April, it shot up and then it kind of settled in. The same thing was true for default spreads. In the middle of the year, default spreads soared. The spread on a BBB rated bond was 1.33% at the start of 2020. By April of 2020, that spread was almost 4%. Think about that. Same company, same rating, your default spread would have widened or tripled over a period of 4 months, which means if you're computing your cost of cap for that company in April of 2020 rather than January, you would have a much higher cost of debt, even though your rating did not change. It's another plea for being dynamic and forward-looking, to live in the world you're in, because as risk premiums and default spreads change, you're trying to incorporate that into your cost of capital. So I want you to try to do this for your company, because again, none of the things that I did is complicated, but you can see very easily that the details, if you're not careful, can get in the way. So if you have an actual rating for a company, look that up first. But even if you have an actual rating, I want you to try to go through the process of getting a synthetic rating. If nothing else, just you can get your hands dirty. An interest coverage ratio, saying, what if my company is losing money? What the heck are you doing picking a company that's losing money? Didn't I tell you not to pick that company? But let's face it, some of your companies will have lost money in 2020. You never saw it coming. If your company lost money only in 2020, but it was making money before, then the fix is easy, right? Go back and look at average income from 2015 to 19. If your company has never made money, it shouldn't be borrowing money in the first place, but if it is, and you cannot get a rating and you cannot attach it, just give it a double B, single B, move on. There's really nothing you can do with a money-losing company, no rating, there's debt on its books, and the debt is large enough that you should be worrying about the cost of debt. Any questions on cost of debt? So we've got a cost of equity, risk-free rate beta, risk premium, cost of debt, risk-free rate default spread, and a marginal tax rate. And for most of your companies, debt and equity pretty much takes care of your capital. But once in a while, you can have what I call hybrids. You know what a hybrid is? It's part debt, part equity. I'll give you two classic examples. One is convertible debt. It's a cleaner example. When you have convertible debt, you have a straight bond, debt, plus a conversion option. The debt, of course, is debt. The conversion option is equity. With convertible debt, my suggestion is, rather than think of it as a third way of raising capital, break it into those two pieces. The debt part goes into debt, the conversion option goes into equity, takes the problem off your books. The other hybrid, and this is a pain in the neck, I absolutely hate it when I see a company raising money from this source, is preferred stock. Preferred stock is not equity, at least in the US. And it's different in other parts of the world. Latin America, preferred stock is just common stock with different voting rights. But in the US, preferred stock is glorified debt. It's very expensive debt. Let me explain why it's very expensive debt. Preferred stock, you pay a fixed dividend. The dividend yield becomes your cost of preferred stock. It's as simple as that. Why is it expensive? Because the dividend is not tax deductible. So if you pay a 6% preferred dividend yield, you're not getting the tax benefit, which raises the interesting question, why would companies ever issue preferred stock? It's an absurdly inefficient way of raising capital. Why would companies ever raise preferred stock? I'm going to come back to the question, but let me deal. There are a couple of hands up, and I'm sorry, somebody had their hand up and they put it down. So if you can put your hand up. Ashwin, go ahead.
Professor, sorry if I missed this, but if you have a company's corporate rating, where do we get the spread from for the given rating, the spread number?
Well, you could get it off, there are a couple of places. One is you can go to Bloomberg, which gives you, spreads. Because if you think about where the spreads come from, they come from the market by looking at other bonds of the same rating that are traded and looking at the yields to maturity. And Bloomberg keeps track of that. I think and I'll send you the symbol you use to get that. The numbers on my website are January 1st, 2021 numbers. They're pretty updated. So if you want to use those spreads, you can get away with it. The numbers haven't changed that much. But it's a market-driven number. It's not a number that Moody's gives you or S&P gives you. You go to the market, you find bonds in that ratings class, you see what they're trading at, and you compute the spread based on that.
Got it. Thank you.
Yeah. Sam?
I was just going to say, would it not be a benefit for preferred stock that essentially a company could halt payments and not, go into a default or risk kind of being pushed into Chapter 11?
Why not just issue equity? Why? If you're that worried about not being able to make payments, why not just use equity? This seems like a very ham-handed way of getting yourself into trouble through the back door.
I guess because in theory, their cost is still lower of the preferred stock versus the equity.
But you still have to pay the preferred dividend, right? You've added a commitment. It might not be a commitment that puts you into default, but it's still a cash flow you got to come up with. Henry?
Aren't management teams trying to thread the needle of the earnings per share target that they get comped on versus managing the leverage ratios and the other things that they're either required to for?
One is this unhealthy obsession that US companies and analysts and investors have with dilution. It's a one bogeyman, right? You mentioned the word dilution, everybody runs out of the room. You know what dilution is? The worry that you have to issue new shares. Preferred shares seem like a way you can avoid that because those shares don't get counted for per share purposes. It's a very unhealthy reason for doing it though, because remember, if you need the money to take a project and you don't have the cash flows to service debt, what the heck are you doing issuing a security where you're agreeing to pay a fixed payment in the future? So one is dilution. But I'll give you the two sectors which are the biggest issues of preferred stock, and you can see why they do it. The biggest issues of preferred stock in the US are banks. And you know why banks like preferred stock? Because it is counted as part of the regulatory capital base when regulators decide whether they're adequately capitalized. So they're saying, look, I don't want to issue equity. My equity investors will get pissed off. But you know what? I'll issue preferred stock. I need capital. They've committed themselves to paying 5% dividends now. That locks them in. So one is banks, and they're doing it to thread the regulatory capital needle. The second are very young, high growth companies. But they don't just issue preferred stock. They issue convertible preferred. A lot of venture capitalists, for instance. You know why venture capitalists like the convertible preferred? Because they know that if the company does well, they can convert to equity, and that's their plan. So it's mostly conversion option. But the cash flows also give the venture capitalist bargaining power. If the company is unable to make those cash flows, the venture capitalist can come back and say, give me a 5% more of your company. So they use it as a negotiating factor to essentially get more control. The bottom line is when you look at your company, and you look at the capital, pray and hope there's no preferred stock. And if it is, it's such a small number that you can act like you didn't see it. Because if there is a substantial amount of preferred stock, you have to open up a third source of capital. You'll have debt, you'll have equity, and preferred stock. Because you can't throw preferred stock in with debt. You know why? Because you don't get a tax advantage. It happens in about 1 in 200 companies. So it's not common. But maybe your company is one of those 200 that actually raises significant amounts from preferred stock. Open a third component, which would be preferred stock. The cost of preferred stock is just the preferred dividend yield. You don't need betas, you don't need risk-free rates, you don't need default spreads. Just take the dividend divided by the preferred stock price and move on. Dan?
I was going to ask, shouldn't equity investors in emerging markets be skeptical of the bond ratings internationally? Because like, what if the Chinese national government decides to restrict capital flight, but that's not captured by the bond rating, and then you invested in a Chinese company, and you can't pull your
Would
money out.
lenders be even more concerned than equity investors? Everybody should be concerned, but I think the first line of pain will be people who lend based on the rating and find that they've seriously misestimated how much they can collect in a crisis. So I think lenders will be, everybody's hurt when you misestimate. Excuse me, Siri's waking up, I don't want her to. Okay, so lenders basically will be the first line, but equity investors will be hurt as well. Shreya?
In the US, does the principal element of the preferred stock have a contractual claim, or is it a residual charge?
It's preferred stockholders can't force you into bankruptcy.
At all.
A lot of preferred stock in the US is cumulative preferred stock, which means if you don't pay a dividend in a year, you just have to accumulate and pay it in a year. So eventually you have to pay it. But the key, and this is what somebody pointed to, is debt, you can be pushed into bankruptcy. With preferred stock, they can get control of the company, they can get voting shares if you don't make payments enough, but they can't force you into bankruptcy.
Got it. Thank you.
And preferred stock often doesn't have a maturity. So basically there's no face value to preferred stock. It's a perpetual security. So right, you just collect dividends as long as the company's in existence. And if there's a face value, it's only in liquidation. So now let's, any other questions? Okay, so let's talk about the weights. So we've talked about cost of equity, we talked about a cost of debt. Let's bring them together in the weights. So I'm going to state the basic proposition. The weights we use for cost of capital calculation should always be market value weights. As opposed to what? As opposed to book value. Having said that though, about half of all companies, when they compute cost of capital, use book value weights, book value of equity and debt, and they give all kinds of strange reasons. Here's one. They'll say book value is more reliable than market value. You know why? Because it doesn't change as much. That part of that statement is true, right? Book value doesn't change as much as market value. In fact, how often does book value change at a company? Book values come from balance sheets. They change only when the balance sheets get redone, which for a US company might be only once every 3 months. Market values change every moment of every day. This is an absurd reason for using book value. Like, it's like the analogy I would offer is this is like claiming that a thermometer that's stuck at 98.6 degrees all the time is one that's is always more reliable than one that tends to move around just because you have a fever. You could be dying with 166 degree temperature and everything's okay with that fixed temperature thermometer. This to me is a weakness of book value that doesn't change very much. But for some reason, accountants value things that don't change and book value is more reliable. The second thing I've been told is to give you more, you're being conservative, you're an accountant. You know what though, if that's your objective, don't use book value, because with book value, debt ratios and equity, you'll end up with a much lower cost of capital than with market value. Why? Because book equity is much lower than market equity. The weights you will get will weight debt more, equity less, which for most companies will lead to a lower cost of capital. And then people will start to stretch. They say, but my returns are computed based on book value, my accounting returns. You're right. So what? Your capital still has to be raised from the market. Nobody goes to market and issues equity at book value terms. There is no good reason for using book value. But as I said, people continue to use it. So we need market values, right? The market value of equity, if you're a publicly traded company, should be pretty straightforward. Share price times number of shares. You have multiple classes, count them all. So you can go to Yahoo Finance, you can go to Google. Basically, you can market cap's easy. But let's talk about debt. Debt, actually, it's much more difficult to get market value of debt for a simple reason. Most companies have some debt at least, or a significant portion of their debt, which is not traded. We act like every company issues bonds to borrow money. Very few companies raise all of their debt from bonds. They have bank loans, they have leases. This debt, you have a book value, but you don't have a market value. So here's the quandary people often face. They can get market value of equity easily. They go and try to find a market value for debt, and very quickly they realize that 60, 70, 80% of the debt is not traded. They have a book value. They wave their hands and say, I don't have a market value for debt. Therefore, when I'm going to assume book value of debt is a reasonable proxy for market value. If any of you worked at investment banks, that's a standard practice. Use market value of equity and book value of debt. And then you hope that the book value of debt is pretty close to market value. You know what? 9 times out of 10, you're going to get away with it. And here's the reason. Book value of debt and market value of debt tend to be pretty close. Unlike equity, where equity can be 5 times the book value, for a healthy company, book value of debt and market value of debt will be reasonably close. No, I have thrown the healthy company, right? What happens at distressed companies that's going to cause the two to diverge? If you're a distressed company, the book value of debt is what you owe. The market value of debt is what people think they can get from you. And guess what? The more distressed you get, the market value is going to get lower relative to the book value because I don't expect to collect money. So I'm going to give you a quick and dirty way of converting book debt to market debt. It's a shortcut, but it works reasonably well. And I'm going to draw on something you should have learned in foundations, which is how to compute the market price of a bond. Market price of a bond, you take the coupons and the face value and you discount them back at a current market interest rate. What you get as a present value is the price of that bond, right? So I'm going to try to apply that to Disney. And here's what I'm going to start with. If you go to Disney's footnotes, and most companies is going to be true, they'll tell you when their debt comes due, how much debt comes due in 1 year, 2 years, 3 years, 4 years. And then they'll give you beyond 5, beyond year 10. And you can apply maybe a reasonable number to that. If you look at Disney, the weighted average of when their debt comes due is about 7.92 years, basically reflecting when the debt comes due. So the debt comes due in about 7.92 years. On the balance sheet, Disney gave me a book value for their interest-bearing debt. It was $14.3 billion, so $14.288 billion. So the weighted maturity of the debt is about 7.9 years. The book value of the debt is $14,288 million. And if you go to the income statement, the interest expense in the most recent year was $349 million. Trust me, these numbers are all going to come together in one place. So I've got a maturity for the debt of 7.92 years. I've got a book value of $14,288. I have an interest expense of $349 million. If you remember a little while ago, I estimated a pre-tax cost of debt for Disney of 3.75%, risk-free rate plus default spread. So here's what I'm going to do. I'm going to act like all of Disney's debt is one gigantic coupon bond with a face value of $14,288 million due in 7.92 years and $349 million, the interest payment as a coupon every year for the next 7.92 years. So how do we price a bond? We take the coupon, $349 million, discounted back to today. So the first term in the equation, if it looks foreign to you, is just the present value of an annuity of $349 million every year for the next 7.92 years. That takes care of the coupon. At the end of the 7.92 years, I get the face value back, $14,288, discounted back at 3.75%. The present value I get for Disney's debt is $13.028 billion. You're saying, what does that give me? That is my estimated market value for Disney's debt. You're saying, why is it lower than my book value? Because the book interest rate they're paying, if you take the interest expense divided by book debt, is lower than the market interest rate. Remember with the bond, if the coupon rate is lower than the market interest rate, the bond trades at a discount. That's the same thing that's happening here. So when you look at your company and you look at your book debt, at least for the interest-bearing part, this will allow you to convert your book interest debt into a market value of debt. This was in 2013. That took care of the interest-bearing debt. But remember I said leases are also debt? So I'm going to take you through the process of how lease commitments become debt. One of the things that even before 2019, even though accountants treated lease expenses as operating expenses, companies were required to break out their lease commitments for the future. So basically in a footnote, Disney told you what their contractual lease commitments were. So these are what they've committed to pay. Year 1, year 2, year 3, year 4, year 5. And beyond year 5, you give a lump sum. The lump sum was $1,784 million beyond year 5. So here's what I did. I took the commitments for the first 5 years. I took the lease commitment beyond the 5th year, which is $1,784 million. And given how much they were paying in the first 5 years, I acted like it was another 5 years of lease commitments. So basically, I have 10 years of lease commitments. And what's my argument? This is really debt, right? So here's what I did. I took the present value of my lease commitments, and what I got as the present value of 2.93 billion is the debt value of my leases. So basically I have two types of debt at Disney in 2013. 13 billion from interest-bearing debt, 2.93 billion in lease commitments. You add those two numbers up, my estimated market value for debt is 15.96 billion. I don't know whether you remember that. If you go back and look at my bottom-up beta for Disney, I gave you the debt for Disney as a company, 15,961 million. I'm now telling you where that number came from. It's the value of both their interest-bearing debt and their lease debt. And this is what accountants are doing now on balance sheet. So when you look at Disney's balance sheet now, this 2.96 billion, if they do it right, should show up as lease debt on the balance sheet. So you're lucky. You don't have to go through this process for your company if it's following IFRS or GAAP because the lease debt shows up. But right now, companies are also required to show their lease commitments still. Just do it yourself. See if the accountants got it right. Why do you want to trust accountants to do this right in the first place? This isn't rocket science. So this is what the new accounting is required companies do. So for the last 2 years, I've been tracking what accountants are reporting as lease debt. But I've also been computing lease debt for every company to see whether we're pretty close. In the US, I'm coming up with a lease debt that's pretty close to the accounting debt for most companies in most sectors, but I'm running about 20% above what accountants think the debt is. So my lease debt is higher, partly because the accounting rules allow you not to count leases. If you have contingencies that allow you to back out of the lease, I'm still counting it as debt. But go through that Disney process because that process will tell you how to come up with the market value of your debt. So getting market value for equity is easy. Getting market value of debt is a little messier. And once you get the market values, compare them to the book values. Because remember I told you using book value weights will give you a very different cost. Try it for yourself. Take the shareholders' equity on the balance sheet, that's book equity. See how different your debt ratios are going to be. And that's the reason I don't want you to trust debt to equity ratios that come from Yahoo Finance or Capital IQ, because the default when people compute debt to equity ratios is still book value. Which means your numbers can be very different when you do a market debt ratio. You're going to freak out and say, I got a 3% debt ratio. They're saying it's 30%. Don't freak out. It's often a book value that explains it, and you can get it. So let's bring this all together. I want a cost to cap for Disney, right? For cost of equity. This is the culmination of about 100 slides. My risk-free rate is in US dollars, 2.75%. The beta 1.0013 is a bottom-up levered beta. The 5.76% is my weighted average equity risk premium for Disney, cost of equity of 8.5%. For the cost of debt, I started with the 2.75% risk-free rate and added default spread of 1% reflecting their actual rating of single A. I use a marginal tax rate for Disney of 36.1%. 2013, that was the marginal tax rate that Disney reported in the books. They actually were one of the few companies that told you what the marginal tax rate was. Based on the market values I got, which was 15.96 billion for debt and 121.9 billion equity, Disney looks like it's about 88% equity, 12% debt. Take the weighted average, the cost of equity and cost of debt, their overall cost of capital is 7.81%. And as you look at that calculation, you know what should jump out at you? The cost of equity is 8.5%. The cost of debt after taxes is 2.4%. You're saying, why aren't they using more debt? What's your first instinct? If they increase the debt, their cost of capital should go down, right? And you might be right. But don't go there yet because it's not that simple. Because if you just use that comparison, every company should just keep borrowing money. Borrowing will always be cheaper than using equity. But it doesn't necessarily follow that if you increase the amount of debt you have in your balance sheet, your cost of capital will go down. Now that sounds mysterious, but we're going to come back and talk about why changing debt can change everything in this calculation. So for both Disney and Vale, I had the luxury because I had the divisional breakdowns of computing cost of capital for Disney's division. So remember, I did the movie division, the broadcasting. Now I can complete the story. I have a cost of equity based on the bottom-up beta for that division. I have a debt ratio for the division, a cost of debt. I did give all of these companies Disney's cost of debt. And that's for a very practical reason. Disney borrows the money for all of its divisions. There are some companies that actually have the cap of a division borrow on its own. GE, for instance, had a separate rating from GE Capital. Okay? That's not the case for Disney, so I gave them all the same cost of debt. Same thing with Vale. I gave all of Vale's divisions the same cost of debt, and I have a cost of capital for the company. And I won't hit you on the head with the bludgeon, but basically I'm doing for Tata Motors, Baidu, and Bookscape. I'm completing the process. I'm bringing debt into the process, weighting it by how much debt they have. None of these companies have huge amounts of leases. If I had chosen Walmart as my company, we'd be dealing with a lot more in leases. But basically, I have a cost of equity and a cost of capital for every company. So what I'd like you to try to do, I know you might not even have picked your company yet, but remember, spare me my delusions. I'm going to act like you picked a company, you're keeping up with everything we're doing. Try to compute the cost of capital for your company. And this is the number we've been aspiring to get to. And that cost of capital and cost of equity are going to become the hurdle rates we use. And I'm going to leave you with one final thought. I called the cost of equity when I came up with it a hurdle rate. I've now called the cost of capital also a hurdle rate. But the numbers are different, right? So how can I have two hurdle rates? We're going to see in the next class that which hurdle rate you use as a company will depend on how you compute cash flows and earnings. So hold on to that thought because it'll kind of resolve the contradiction. But when we start next class, we're actually going to start with looking at returns. All of this was to come up with a hurdle rate. The next class, we're going to talk about why we look at cash flows, how we go from cash flows to returns. But if nothing else, at least read the case. You don't have to do the case, at least read it. Let it fester. That's a wrong word. Let it stew, let it whatever, read it and start thinking about what do we need to do in the case. And I hope there's somebody in your group that's reasonably proficient in Excel, because there will be some building up of an Excel spreadsheet. If you're learning Excel while you're learning this, it's a little more of a climb, but start thinking about how would you build up to what you need to do to answer the questions of the case. So I'm going to end there and I will see you on Monday.
Thank you.
Take care.
Thank you. Sir, can I ask a quick question?
Sure.
Why do we use the pre-tax cost of debt for leases?
Because the lease commitments are pre-tax commitments. It's just a consistency issue. So the commitments they give you are the commitments before they get the, because remember those lease commitments when they pay them will be tax deductible. This is how much they have to pay before that tax deduction is factored in. So it's a consistency issue. If I'd made those lease commitments after tax commitments, I could have used the after-tax cost of debt.
Thanks.
Jack, your question?
Oh, sorry.
What kind of things is a company like Disney leasing, like equipment and like car, like?
Well, I mean, remember they have theme parks. I don't know what part of the theme parks are leased. I don't know whether in fact, my guess is that that Anaheim, the city owns the land under Disney. It's leased, I think, under a really long-term lease. So Disney doesn't have to worry about it. But I don't think they own all of that land that Disneyland is on. So I think, so when you look at lease commitments, it could be there. They also have the cruise ships, which I guarantee you are under some kind of long-term lease. So it's probably those businesses, not Burbank headquarters leasing. In fact, that's a good question. I don't even know whether they own the Burbank building that they are in. So the leases are probably on many of the physical facilities in their different divisions.
Would that be like a move to like reduce real estate exposure by a company? Would they want to just lease instead of?
Yeah, in fact, I think it's a good idea. If you're a company that's not in real estate, why make yourself a real estate play? There's a reason Marriott took its hotels and spun them off as a REIT, right? Because as long as real estate becomes a big part of your decision making, it lead you down the wrong path. So some of it is to reduce exposure to real estate. Some of it is to give them flexibility. What if they want to move their headquarters to Austin, right? It's much more difficult if they own the building than if they lease it. So it's, I think, both reduce real estate exposure and give them more flexibility.
thanks.
Just a bookkeeping question. So we're on chapter 6 right now, and then our quiz 2 is at the end of the month with our case, correct?
Yeah.
And then what, if we wanted to read ahead, what chapter do you think we should read to? And is it
5
cumulative?
and 6. Basically, it'll be through 6. The second quiz is through 6.
Okay, cool.
7 is financing, so we won't even start it till after quiz 2.
Okay, and then it's cumulative, right? Or no, it's
It's
just
not
5.
cumulative. Yeah.
Okay, 5
But
and
that's kind of a lie, right? Because if you
Yeah.
can't compute a levered beta, you're going to be in trouble when you do project analysis.
Yeah, that's true.
Right, I won't test you on the insides or bottom-up betas, but I expect you to be able to use betas to come up with hurdle rates and cost of equity and cost of capital. So there are parts of quiz 1 that will show up no matter how you frame it, but it'll be less. The emphasis will be on the other parts that we've done: the earnings, the returns, the cash flows.
Yeah, because everything like
Project
builds on top
analysis.
of each other. Okay, thank you.
Exactly. Okay.